If you've ever tried to borrow money from a financial institution and they said no to you, then this video is for you. If you're also considering maybe building your credit or taking credit in future, then this video may also be for you. Thank you very much for coming to my channel. My name is Jadesola and this is part of my personal finance videos that I've been making. If you haven't seen any of my past videos, please go and watch them. I'm going to link them in the description box below. So let's get right into it. Now, every lender, every financial institution, they lend around what is called the 5 C's of credit. Now, before you think that I'm going to turn into a professor on you, calm down. I'm going to try and break this down to you like you're a 6-year-old. So please stay on this video. Now, if you've ever been in a situation whereby you've had to lend a friend or a close relative money, then you understand credit and you understand how financial institutions actually look at you when you want to borrow money. And that's the analogy I'm going to use today. So let's say your friend's name is Joe and Joe has come to you to say, borrow me $500. And then you go ahead, you borrow Joe $500 and you ask Joe, so when are you going to be able to return this? And Joe tells you end of the month, right? End of the month, Joe brings back your $500. That is how Joe starts to build financial or what we call credit history with you, which leads to the first C that financial institutions look at, which is your character. So let's say Joe comes back and says, oh, I need $1,000, right? I will give it back to you in 2 weeks time. And Joe takes the $1,000 and then returns it to you in 2 weeks time. That is good, right? Likelihood that if Joe comes back again, you're going to feel like you can actually trust Joe enough to continue to lend him money. Now, let's assume that Joe comes, right? And then he says, borrow me $2,000. I will give it to you in a month. And then, a few days to, the end of the month, Joe reaches out to you and says, hey, you know what? The money I was expecting to pay you back it's not going to come for another 2 weeks. Is it possible for you to extend me some time, right? Joe is showing you his character about how he is financially responsible and how he cares and appreciates you lending him the $2,000 when he needed it. Now, if Joe does that and then in 2 weeks time, he's able to pay you, that starts to register in your mind that Joe is a good person. Joe will always return my money. If Joe is not able to return my money, Joe is going to let me know. Now, let's assume that, Joe comes again, right, for another $2,000, and then he says, I'm going to give it to you in 1 month. And then in 1 month, you don't hear from Joe. And then you're calling Joe, and then Joe isn't answering your call, you're seeing Joe maybe post on social media, but Joe isn't answering your call. 2 months have gone by, 3 months have gone by, right? The first thing that will happen to you is you're going to think, this is unlike Joe, right? Joe would normally pay. So you're likely going to give Joe the benefit of the doubt because of his past character, right? You will not judge him right away, right? If Joe continues, after 3-4 months, Joe doesn't return the money or Joe continues to give an excuse, even if Joe eventually pays you the money and he comes back again, now Joe has a stain in his record as a good paying friend, right? And really, this is how financial institutions really look at you. When you pay your debt on time, that starts to show good character, right? And if you don't pay your debt on time, if you constantly miss your payments, then you start to look like you're not to be trusted with money. That is the first C. The second C that they look at is capacity. Now, while Joe is not able to pay you, right? You might be thinking about it this way. When Joe borrowed $500, he was able to pay on time. When he borrowed $1,000, he was able to pay on time. Now, when he borrowed $2,000, that's when he started to have problems. Maybe Joe's capacity is not able to accommodate $2,000. Maybe he needs to be in the range of $1,000 or $500. That's how they're looking at you, right? They're profiling you to see how much you would be able to pay back conveniently if they give you money. So lenders will look at your income, right? They would look at, you know, your monthly expenses. So if you're filling out forms, some of them will ask you if you have dependents, how much your monthly expenses can be. They particularly ask for rent again, because rent is usually like your biggest monthly expense, because they're trying to also really gauge you to see what your capacity is or what your disposable income would eventually be when they give you a loan, so that they will know whether or not you can pay them back, right? So we're still looking at Joe to see, hey, maybe when we should have just stopped to giving Joe $1,000, and maybe he probably wouldn't be in the situation he's in. Now, the third thing that lenders look at is collateral, right? So while this may not be like, maybe it may be more for like maybe business people, or maybe sometimes even personal loans and maybe mortgages as well, you know, it is some sort of like secured loan. A collateral is that thing that you put down as, if I'm not able to pay you, you can take this thing off of me and use it to realize all or some of the money that you have borrowed me. That is what collateral is. So sometimes you want to take money from a financial institution and they're asking you for collateral. They're looking for a fallback. If anything happens, if, for example, you have fantastic character, right? And right now you have steady income. But what happens if that income goes away or your business flops and you're not able to pay? How will they be able to realize their own money, which usually is depositors' funds? Really think about it. Imagine going to your bank, hey, I want to withdraw my money, and they tell you, oh, sorry, Joe borrowed money from us, and then because he has not paid back, we are not able to give you your money. Just imagine how you're going to feel. So there are times that banks and financial institutions need to collect these collaterals off of lenders to make sure that they have a bit of comfort, because every form of credit is risky because the money may or may not come back, right? So they're going to be looking at what is the value of the thing that you are putting down, right? How quickly can they realize their money if things go south off of this collateral? Where is the location? What's the value? You know, are there like other attachments to this collateral? You know, they analyze these things before they can say yes to you. Another thing that they look at is what is called capital. So let's imagine this. Joe has come to you, your friend. He says, man, I've got this, you know, business idea. I'm very convinced it's going to make money, right? And then I actually need, you know, $5,000 to really get this business started. You know, can you borrow me $5,000? If that doesn't sound a bell in your head, I don't know what will. Because if Joe needs $5,000 to start a business, and Joe is asking you for the entire $5,000 to start this business, there is a problem. Capital is your stake in the risk that you're about to undertake. So if Joe had come to you to say, hey, I've got $3,000, I need $2,000 for you to support me with. it starts to make you feel like, oh yeah, you know, he's gone ahead to raise some more funds on his own, and then he's coming to you for the balance. Because likelihood is, and this is how financial institutions will look at it, if this thing goes south, let's say this business idea goes south, you know, the only person that is going to be losing out is you, who have, you know, put up the 100% of the capital needed to start this business, right? Because Joe has no stake in this. Joe has only come with the idea. You have come with the capital. Joe, yes, he may feel bad, right? Because he's got this great character. But the honest truth is, he has no stake in it. And sometimes, you know, lenders gauge the amount, the value of your stake as, you know, part of your seriousness, right? You know, how serious are you about this? Sometimes it makes them even look at it because maybe they're taking, you know, you're bearing some risk. They're able to offer you lower interest rates. So for example, if you're taking on a mortgage, right? If you put down 5% deposit on your house and the bank is financing 95%, you're not going to get the same interest rate as someone who is putting down 20 or 25% and the bank is only financing, you know, 80 to 75% of the balance. And that is how lenders look at you. The final C that lenders look at is what they call conditions. Now, these conditions could be internal or external. Now, I'll break it down. There are times that you want to take on credit, and let's say, let me use COVID as an example, right? There was so much uncertainty when the pandemic hit, and a lot of people didn't know if people were going to lose their jobs or if companies were going to survive. So the easiest thing that a lot of lenders were doing was, hey, there's this condition out there that we can't control. We don't know what's happening in the world. Some lenders actually stopped lending, right? They were not lending, or they were only taking risks on people that maybe had already over time showed track record. They have credit history with them. They probably will not take on someone entirely new. You know, people were being very cautious. Another example could be, so there was a time in Nigeria that, you know, prices of crude oil really crashed, and people were not sure what was going to happen to people that worked in the oil sector. So if you were in the business of maybe crude oil, for example, and you went to a bank for credit, they would be looking at you differently at that point in time. Even if you have a fantastic credit history, they're going to now be considering this industry you're in that is having some sort of setback, right? Another part of condition could be even the condition that the bank or the financial institution is giving to you as a condition to lend to you, right? Can you meet this condition? Do you have this kind of income? Can you give us this proof, this collateral? Can you, you know, they're going to set out a list of conditions to say, hey, if you're able to meet this, right, then maybe you're good enough for our credit. So this is how really like financial institutions really look at you before they say yes or no to you. So if you've been borrowing money, right, you would have a credit file, which usually they would see on credit bureaus about your history, how you have been borrowing, how you have been paying back, your interaction with money in general, right? And if you've never borrowed before, they don't have any history on you. They can't gauge you. And while some financial institutions, what they will do is they may give you a chance, but they will offer you a very high interest rate, as opposed to when you have now like built history with them, you've been borrowing money, you've been paying back, then they can start to reduce the interest rate. So really, like, think about it. I know that where I come from, they see credit as a bad thing, but in the Western world, it is actually like the backbone of the society. A lot of things are done on credit, and there's a way you can actually take advantage of credit without actually it being a bad thing for you in the long run. Now, if you've learned 1 or 2 things from this video, feel free to like, share, and subscribe, most especially. And I will see you next time in class. Bye.